Hello, today is July 24th, 2026, and it's time for some stock picks. This time last year, I picked Allison Transmission, ALSN, Hartford Insurance Group, HIG, and Alphabet, GOOGL. These stocks were up 23.6%, 17%, and 96.9% respectively in US dollars, including dividends, for an average return of 45.8%. This compares with the 21.6% for the MSCI World Index in US dollars, including dividends, as represented by the URTH ETF. Despite inflation being higher than average, the war in Iran, and an economy that's mostly flat, with the exception of AI spending on things like GPUs, CPUs, data center build-up, AI model research and development, world equity markets have continued to perform very well, as is evident by the performance of the various equity benchmarks. Google, for example, almost caught up with OpenAI and Anthropic on the AI front, and the market rewarded that stock handsomely. Going forward, however, we believe that equity returns will be below average as stock valuations are well above average. It is therefore even more important than usual to own good companies that trade at reasonable valuations in order to have good returns for the next 3 to 5 years and beyond. Top stock picks for July represent such investment opportunities. My first stock pick is APA Corp, symbol APA on the NYSE. This is the old Apache Corp, a major oil and gas producer with approximately 80% of revenues from oil, 10% from natural gas, and 10% from natural gas liquids. Its main operations are in the Permian Basin in Texas and New Mexico, in Egypt, Suriname, and Alaska. The bullish case for oil and gas stocks centers on a strong global demand, companies prioritizing steady profits over overproduction, and ongoing 2026 supply threats in the Strait of Hormuz, keeping prices high. APA stock is cheap due to short-term worries, possibly about political instability in Egypt, but the reality is that they are successfully cutting costs in Texas to pay down debt and fund reliable dividends. Additionally, APA is building a massive offshore oil project in Suriname set for 2028. Buying APA today could give us a highly profitable, cash-generating business right now, plus huge future growth potential at a major discount, trading at about 6 times earnings. I like it. My second stock pick is going to be a property and casualty reinsurance company, Renaissance Re, symbol RNR on the NYSE. The Bermuda-based reinsurer bounced back impressively in 2026 after the losses the sector experienced last year with the California wildfires. Structural hard market conditions in property and casualty reinsurance, driven by inflation-linked demand and disciplined pricing, are generating exceptional profitability across the sector, with Renaissance Re standing as the premier beneficiary. R&R is capitalizing on these tailwinds by leveraging its unmatched property catastrophe expertise, a rapidly expanding casualty and specialty portfolio following the Validus acquisition, and a capital-light third-party capital management platform that generates high-margin fee income. Backed by stellar combined ratio, strong balance sheet, and aggressive share buybacks driving rapid book value compounding, R&R offers a great risk-adjusted return profile for investors. It's trading at a compelling valuation of about 8 times earnings. My third stock pick is AerCap Holdings, symbol AER, on the NYSE. With about $27 billion in market capitalization, AER is the world's largest company in the aircraft leasing business. The bullish thesis for AER Holdings in 2026 is anchored in a structural supply-demand imbalance that essentially forces airlines to become price takers in the leasing market. Persistently high global air traffic demand is colliding head-on with severe OEM production and bottlenecks at Boeing and Airbus, which are further compounded by ongoing engine durability issues that keep existing planes grounded. Because airlines cannot reliably acquire new aircraft directly from manufacturers, they are heavily dependent on lessors to secure scarce capacity. As the world's largest aircraft lessor, AER is perfectly positioned to exploit this environment, driving lease rates significantly higher and generating massive gains on asset sales as aircraft values remain historically elevated. Furthermore, management is aggressively converting this cash flow windfall into shareholder returns, highlighted by a 1 billion share repurchase program extending through 2026, while continuously refreshing its $70 billion portfolio with high-demand, fuel-efficient assets like 787 Dreamliners, cementing supreme pricing power, long-term earnings visibility, strong fundamentals, and a good valuation for the stock, which trades at about 8 times earnings, make it a stock we like. And as always, if you have any questions about these investment opportunities or any other investment-related matter, please give us a call. Thank you and have a great day.